All right, today we're diving deep into a really interesting company, Vinati Organics. Now, these guys are a major player in the specialty chemicals industry, but their stock has taken a pretty big tumble recently. So let's get into it and figure out what's going on.
So the story really starts with this one pretty dramatic number. The company stock is down almost 40% from its 52-week high. It's trading right near its low for the year. That's a huge drop. So what's the deal?
And that, of course, leads us to the big question we're here to answer. Is this a sign that the business itself is broken? Or could this actually be a brilliant bargain hiding in plain sight? Okay, to figure that out, we have to start with the fundamentals. Let's peel back the layers and see what kind of company Vinati Organics really is at its core. And this is absolutely crucial to understand. Vinati isn't just some local player. We're talking about a global champion. For its two main chemicals, ATBS and IBB, it commands the #1 spot in the entire world market. That's some serious market power. Now, that kind of dominance gives the company what investors love to see, a wide economic moat. If you're not familiar with the term, think of it like the moat around a castle. It's a powerful, unique advantage that protects the company's profits from competitors. So where does this powerful moat come from? Well, it's built on 3 key pillars. First, they control their own supply of key raw materials, which is a huge advantage. Second, they have more than 35 years of specialized knowledge and experience. You just can't copy that overnight. And third, it's a massive pain for their customers to switch to anyone else. We're talking years of product qualification. Okay, so the business model itself looks rock solid, but a great moat doesn't tell the whole story, right? What about the company's financial health? Let's pop the hood and take a look at the numbers. Well, the report card here is pretty much perfect. The company scores a flawless 9 out of 9 on the Piotrowski F-score. For those who don't know, that's a really tough 9-point checklist designed to find the most financially sound companies. And Vinati, well, it ticks every single box. And when you dig into the details here, you can see just how strong this financial fortress is. Their debt-to-equity ratio is basically 0. They're virtually debt-free. Their interest coverage is extraordinary, meaning they can pay their interest bills hundreds of times over. And this last one is key. Their cash flow is higher than their reported profit, which is a huge sign of high-quality, honest-to-goodness earnings. And it's not just one metric pointing this way. The analysis ran 3 different quantitative models: the Piotrowski score, the Altman Z-score for bankruptcy risk, and the Binish M-score for earnings manipulation. You know what? All 3 came to the exact same conclusion. Vinati's financials are pristine. 0 red flags. So, let's put this all together. We have a world-class business with an unbreakable moat, and its finances are squeaky clean. This brings us right to the heart of the whole thesis. This massive disconnect between a high-quality company and its current beaten-down stock price. This chart shows that disconnect perfectly. Historically, over the last 5 years, the stock has traded at a price-to-earnings ratio of around 40, but right now, it's all the way down at 27. That's more than 30% cheaper than its own recent average. It's clear the market has gotten way more pessimistic. So the report then lays out a few potential scenarios for the future. In the worst case, or bear scenario, the downside from here is about 14%. But in the base case, the potential upside is a whopping 58%. And if things go really well in the bull case, we could be looking at a return of over 100%. And that leads us to this simple number, 4.1x. What this means is that based on the analysis, the risk-to-reward setup looks incredibly favorable. For every $1 of potential loss in the bear case, there are over $4 of potential gain in the base case. That's a fantastic asymmetry. All right, so after looking at the business, the financials, and the valuation, what's the final verdict? And just as importantly, what are the key risks we absolutely need to keep on our radar? The report's conclusion is pretty direct: accumulate. The thinking here is that this isn't a crisis, but a rare chance to invest in a top-tier, global leader while the market is looking the other way. So the whole bull case really boils down to 3 simple steps. 1, you have a dominant global leader with a fantastic moat. 2, you have a clear catalyst for future growth with a major expansion already happening. And 3, you get to buy in at a significant discount. That's a really powerful combination. But of course, no investment is ever a slam dunk. The report is clear about the risks to watch.
there's some uncertainty in the demand for one of its key products. The company also gets a huge chunk of its revenue, about 45%, from just 2 product lines. And finally, there's always execution risk when you're taking on big new expansion projects. All right, before we wrap up, let's just go through a quick but very important disclaimer. Now, please keep in mind the analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks, and the data and charts you've seen are based on public information and my personal research notes. So please, do not treat this as a buy or sell recommendation. It is absolutely crucial that you conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and you want to stay updated with more stress-free investing analysis, please do me a favor and hit that subscribe button and be sure to press the bell icon so you never miss an update. And now I want to hear from you, which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might just be the subject of my next explainer.
Thank you so much for watching, and as always, keep your investing stress-free.